Thank you for joining us for a special edition of Market Thoughts. These are challenging times that we're in, and they go far beyond financial markets and financial measurement. And while they're unprecedented and they're unsettling, the volatility that they've brought isn't new to us. And so, to discuss them as well as how we're positioned in our portfolios, I'm delighted to be joined at home by our CIO, Richard Madigan. So, Richard, before we jump into markets, I think it's helpful maybe to give some context. We began the year overweight equities in our portfolios by about 2%. As the COVID news started to come out, we moved to neutral in early March, and then shortly thereafter went to an 8% underweight as the virus shifted from something that was thought to originally be contained in Asia to something that had the makings of what it is now, which is a global pandemic. And since that time, we have seen equity and fixed income markets bounce around a lot. And most recently, we've seen equities bounce 20 to 25% off their lows as more and more details emerge around the healthcare implications. And so, with all eyes kind of rightfully focused on the personal toll that this is taking across the world, I want to spend some time with you talking about the economic toll and ultimately like what it means for portfolios. So maybe a good place for us to start is just around what the Fed and some of the other central governments have done as a response.
I think it's important to kind of emphasize, I think all policymakers learned a lot from the financial crisis, and US policymakers in particular. If I had to pick a mantra for it, I think it's now move fast and don't break things. The response has been incredibly comprehensive, and that's not only from a monetary perspective, so central banks and the Fed, as you emphasized, but also fiscally. And I actually think the fiscal easing, the fiscal response is going to be the one that is the most important in sustaining the economy through the next quarter or two. But I'm saying that recognizing that I think the Fed is probably in particular really focused on making sure that liquidity is back in treasury markets and core bonds. And the actions we've seen have been incredibly supportive for credit markets, which were almost under distressed conditions in late March and early April. The good and the bad news from Washington's perspective and what happens with regard to fiscal policy, I think, is we're in a spend whatever it takes mode. And so while you're watching the Fed focused on zero interest rates, I think Washington is focused on unemployment checks to keep income coming in as best they can and small and medium-sized enterprises so that we don't lose too many businesses along the way. I say all of that constructively, but I also want to recognize there's a cost that's associated with this. So there's going to be a bill to pay with regard to extending debt to GDP and what that means to the broad economy. But I think the cost of not acting as aggressively as we're seeing policy actions right now is far greater than no action.
The Fed dropped rates to zero. Yep. I think it's probably fair to say that we're going to be in a low interest rate environment for a while. If I'm not going to earn that much on fixed income, wouldn't I be better off just taking the easy trade in and putting that piece in cash?
So the favorite Madigan word is optionality, and you get optionality in bonds. We talk all the time about the fact that interest rates are low, but bonds are actually out yielding cash, so don't lose sight of that. The optionality dynamic fills in with regard to bonds as a risk diversifier. And again, I know the yield is unexciting, but I can tell you that the duration that we've held in portfolios through all of the volatility that we've seen over the course of the last 3 months and longer has helped buffer drawdown. So bonds are doing exactly what I want them to be doing right now. Now, you start to think about the cash versus the core bond dynamic when I'm worried about inflation. So as inflation comes back into the equation, then we'll be much more watchful of that dynamic between full duration and short duration. But quite honestly, over the next 9 to 12 months, I think I'm more concerned about slower growth and disinflation than I am whatsoever in inflationary shocks.
You recently started to build a position in high yield.
Yep.
And when I look at that, I guess I immediately think, hey, does that mean that it's kind of safe to go back into the market?
The most important positioning for me right now in portfolios, if you want to read a view, is the fact that we're underweight equities. So I'm still playing what I'm going to call proactive defense around risk taking in markets. We added to high yield in late March when credit spreads blew out, and we just simply felt that default risk was exaggerated. We sold out of high yield last year and stepped back from it. We're now beginning to rebuild positions in high yield. So I guess it's a first salvo to rebuilding risk positions in a portfolio. I'm also using it to barbell against core bonds to add a little bit more yield or carry into portfolios because I can put a higher probability certainty of return on an income stream than I can the variability of risk assets, whether that be extended credit or its equity markets. So I
Yeah.
expect us to continue to build into those portfolios when we see the right opportunities. But there's an awful lot of things that are still unknown out there.
You started to build some of those defensive properties within the equity components of a portfolio last year.
Yes.
And as I look at how things are evolving now, it looks like you're overweight to the US, which you've had for a while. Is even higher than it was before. Is that a statement about the US or a statement about other places?
Both.
Yes.
And I'm not being cute on that, but I think it's meant to be a big statement about some of the policy response that we've talked about, and the U.S. probably being the most assertive and proactive. So, ironically, I'm leaning further into the U.S. With a view that it's the more defensive allocation, and I actually think the one that can come out faster as we start to stabilize the economy and it gradually begins to recover. Within that, you mentioned some of the things that we've been positioned around defensively last year. Healthcare remains a sector in the US that we're leaning into strongly with defensive characteristics and feel good about. Technology is as well, and specifically within technology, the cloud. I think the real wild card right now, though, for everyone are going to be earnings this year.
How do I know if markets are expensive or cheap if you don't have earnings and CEOs don't really want to give guidance because they don't know?
The short answer is you don't. And so I question anyone that is pretending to have a view on relative cheapness or how expensive a market is this year right now. We simply don't have that visibility. You need earnings to have a view on multiples and valuations, and we don't have them. And literally, as we're going through this earnings season and talking to companies, the number of companies that are just pulling guidance for this year is astounding. And by the way, they're doing it for the right reasons. They just don't have the visibility around it. I think the structural thing that's changed from the market's perspective and for investors is the policy response we've talked about, because it has been so assertive that what investors in the market are doing right now is basically writing off this year. They've said, we don't have visibility, we don't understand it, but we believe that the extreme left tail will be curtailed with regard to staying in recession and not that becoming something worse. What that's allowing investors to do is look into 2021 and even 2022 just to get an anchoring for the fact on where do they think we recover to, and then what multiple can you factor into that. But there's more guesswork in that from everyone right now than there is any certainty.
If I'm a client, what I guess want to know is, as you sit here today, would you think stocks are higher as we look out the next year or two?
I believe they will. And I think that's a really important point, because if I didn't, we'd actually have a higher underweight in our equity positions right now. These are really unprecedented times. So any pretense of certainty right now around almost anything, I challenge an awful lot in terms of being caution. And that reflects the caution we're taking in portfolios as well. As I've kidded you 1,000 times, I'm passionate about a lot of things in life, but never around markets.
As you think about that recovery phase, that would change some of your underlying positions. Are you looking at that, or am I too early in even asking that question?
So you're early in asking it, and we're early in looking at it, because I want to manage expectations on kind of how we get there. And you've heard me also say 1,000 times, we're active managers. So I always want to be anticipating where I think we're going in the market cycle and where there are opportunities. The intent is to rebuild risk positions. And we talked a little bit about that with regard to high yield and extended credit. The next logical step is starting to reduce our equity underweight. We've actually just begun to do that this week. So again, good leading indicator in terms of stepping back up into markets. I've also got a shopping list with the team. And I think the two things that stand out, if I had to pick them right now, the US financial sector and industrials. Like those are two areas that have been under a tremendous amount of pressure. And on that 18 to 24 month horizon, I think offer an awful lot of value in terms of opportunity.
I think the news and the events of our times has shaken financial markets and all of us. And as you've heard from Richard, we've responded accordingly in our portfolios. So let me see if I can put all those pieces together. The next few months bring the possibility of more downside as markets factor in the economic impact of reopening our global economy, which is why we're cautiously positioned with an equity underweight. But that has started to shift. Since establishing that original underweight, we've added a little bit of equity back. We've started most notably in the form of high yield, which offers the ability to gain equity-like returns with potentially less risk in that process. And while it is early days, that trade is working as broader fixed income markets stabilize. Within equities, we maintain our overweight to the US, which entered the crisis in the strongest financial position, and likewise, we'd expect to emerge the fastest. Longer term, we remain cautiously optimistic, but pragmatic to know that there will be bumps along the way. But we're prepared for that in our portfolio as we've been through previous crises. But all of us are here to help you make informed decisions, not just about your portfolios, but about all of your financial goals. And I know I speak for Richard as well when I say, please don't hesitate to contact us with any questions or concerns as we all do our best to stay ahead of developments in our rapidly changing world. Thank you. And thank you, Richard.
Thank you, Nancy.